You did everything right. You earned the title, cleared the six-figure threshold, moved into the right zip code. And yet, your liquidity is tighter than it was 3 years ago. That's not a spending problem. That's a targeting problem. Because right now, there is an entire industrial complex, luxury real estate brokers, private school admissions offices, European automotive brands, that has profiled you with surgical precision. They know your household income bracket. They know your profession. And they know that the single most powerful lever they can pull isn't desire. It's fear. Specifically, the fear that choosing less signals failure to your peers. This is not about extravagance. It's about 5 purchases that have been deliberately repackaged as rational, responsible, even protective decisions. For your family, your children, your future. And they are quietly liquidating your asset base, one investment at a time. Status trap number 1. The zip code premium. The luxury marketing complex doesn't sell you a house. It sells you an identity address. The average price differential between a 90,210 adjacent zip code and a comparable school district home 30 minutes away can exceed $600,000 to $900,000 in major metros like Los Angeles, Greenwich, and Bethesda. That delta, financed at today's mortgage rates, translates to an additional $3,500 to $5,200 per month in pure carrying cost. Capital that, structured into a diversified equity portfolio over 10 years, compounds into a materially different retirement trajectory. But the private school admissions consultant told you the zip code matters. The broker confirmed it. And your LinkedIn network quietly validates it. Every time someone asks which neighborhood you're in, this is what behavioral economists call positional consumption lock. Spending driven entirely by correlative status, rather than absolute utility. Status trap number 2. The private school investment. This is the most emotionally fortified trap on this list, because no sophisticated professional will publicly question their child's educational environment. That's the design. Elite K-12 private school tuition in major U.S. metros now ranges from $40,000 to $65,000 per child, per year, after-tax dollars, because there is no federal deduction for it. For 2 children, that's $80,000 to $130,000 annually. Over 13 years of schooling, you are deploying between $1,040,000 and $1,690,000 in post-tax capital, with zero guaranteed return on that asset. Research from the Brookings Institution and Stanford's Credo studies consistently shows that peer effects and parental engagement, not institutional prestige at the K-12 level, are the dominant drivers of academic outcome. But the admissions office doesn't send you that study. They send you the alumni donor list. Status trap number 3. The luxury SUV as safety infrastructure. The framing is always the same. Crash ratings. All-wheel drive. Space for the family. What the financing disclosure doesn't frame is this. A $95,000 luxury SUV financed over 60 months at current rates carries a monthly payment north of $1,700, depreciates roughly 49% to 55% of its value within 5 years, and generates zero income. It is a pure liability wearing the costume of prudence. The luxury automotive complex specifically targets high-earning women with messaging that anchors the vehicle to maternal responsibility, not status. Volvo, Mercedes, BMW. Their entire marketing architecture in the $75,000 to $110,000 SUV range is engineered around safety narratives. You are not buying performance. You are buying permission to spend without guilt. Status trap number 4. The curated wardrobe tax. In high-earning professional environments, particularly finance, consulting, and corporate law, there exists an invisible dress code far more expensive than any written policy. A single capsule wardrobe refresh at brands positioned as investment pieces. Loro Piana, Max Mara, Brunello Cucinelli runs $15,000 to $30,000 annually for a woman in a visible senior role. This is justified as professional necessity, and partially, it functions as one. But the psychological mechanism underneath is social proof spending, the compulsion to signal peer group membership through consumption, rather than through performance. The wardrobe doesn't generate revenue. The client relationship does. These are not the same asset. Status trap number 5. The destination wellness infrastructure. Equinox membership. Quarterly wellness retreats. A dedicated nutrition protocol. A private trainer. Individually, each is defensible. Collectively, they form what I call the wellness premium stack, an annual expenditure that, in high-cost metro areas among senior professional women, routinely exceeds $28,000 to $42,000 per year. The tragedy here isn't self-care. The tragedy is that this stack has been successfully repackaged by luxury wellness brands as productivity infrastructure, a deductible business expense of identity. It rarely is, from an IRS perspective, and it rarely appears on anyone's personal balance sheet, as the liability column it occupies. The aha moment. The invisible liability wardrobe. Here is the diagnostic framework that changes how you read your own financial statements. Every one of these 5 traps shares a single architectural feature. They are illiquid status positions, disguised as either protective spending or investment. They generate no yield. They cannot be liquidated in a liquidity crunch without social cost. And critically, they are never reviewed on a quarterly basis the way an equity portfolio would be. A sophisticated institutional investor reviews every position for performance. You should review your lifestyle expenditure the same way. Not with guilt. With precision. The behavioral architecture fix. The institutional grade correction is not a budget. Budgets fail because they operate on willpower, which is a depleting resource. The correction is a shadow balance sheet audit. A quarterly, non-negotiable review, where every recurring expenditure above $1,000 per month is assigned a column. Does this produce yield, preserve capital, or signal status? Status column items are not immediately eliminated. They are rate limited. You set a hard ceiling on the total percentage of post-tax income allocated to the status column. Institutional standard is below 12%. Anything above that ceiling gets redirected automatically into a pre-designated brokerage or alternative investment account before discretionary spending is even visible. Automation removes the social anxiety of choosing less, because the decision is structurally pre-made, not emotionally negotiated at the point of purchase. The 5 traps you just examined aren't isolated spending decisions. They are the downstream behavioral output of a deeper systemic targeting infrastructure, one that identifies high-income earners by asset bracket and deliberately redirects their capital away from wealth-building structures. And the institution doing the most sophisticated version of that targeting isn't a luxury brand. It's happening inside the financial advisory complex itself, where wirehouses and mass-market wealth managers have built an entire product architecture designed to absorb the capital of $300,000 per year earners before it ever reaches a compounding vehicle. Click the video on your screen right now, and let's pull back the next layer to dissect how the mass affluent slaughter is engineering the quiet financial erasure of America's highest-earning professional class.